So I've gone on a little bit about inverse correlation over the last couple of videos. So I just wanted to quickly show a little bit about what that looks like. Now I've got a couple of key sectors and funds up here. So number one, I think, is the purple here, Spider. Now the Spider S&P fund is the S&P 500 fund. And as we can see, over the last 5 years, it has largely gone up. We had the COVID pandemic crash, and we've had quite a bit of motion around that as well. Now the question is it possible for us to compose a portfolio that will take away some of the sting of these big falls? And we're talking about some fairly substantial falls here as well. A commonly used fund would be gold. So I have here the GLD ticker. And as we begin to zoom in really on this relationship during this time, we see that during 2021 to 2022, gold more or less moved in the same type of pattern. It moved down. And so I can see that gold itself isn't necessarily going to work. Now one that I do use is VIRT. Now this is a company that earns money on the basis of fast movement. So when there's a lot of transactions, they earn more money. They do pay a dividend. It's about 5%. It's been a steady dividend, and the company itself is highly profitable. And we can see here that as the initial sort of sell-off happened here in January, VIRT accelerated in terms of value, but at the same time here, they fell in tandem. And so that by itself is possibly not the best solution for me. However, when I look at KMLM, which is a commodities-based fund, we can see that as the SPY fell, the commodities were gaining. Now, it's not a perfect inverse correlation, and it doesn't hold true all of the time, but a portfolio comprised of these two assets at this time would have worked really well. Now the other benefit is, as SPY came down and as KMLM goes up, if I had sold KMLM here and bought into SPY, I would be doing well. I'd be selling high and buying low and rebalancing. So one of the keys with inverse correlation is not just to set it and forget it, but also benefit from that rebalancing effect, which helps you to gain or lock in the benefits here of the gain in one asset class by the other asset class when it's down, and begin to ride out. Now we can see here again on this angle here that KMLM drops as SPY is gaining, and again as SPY drops, KMLM is gaining. And so we can see here that beautiful inverse correlation at play, enabling us to weather out some of these storms, and with the rebalancing effect also benefit financially through some of this inverse correlation. Why else do I enjoy KMLM? Not only is it inversely correlated with the broader stock market, this lack of correlation has benefits, and I don't need to hold, say, 50% of my portfolio in KMLM to benefit from this. I can hold a much smaller portion, say, of the core and a core satellite position to actually benefit from this quite successfully. What do you think? Do you have any assets like that you are holding purely for the stability within the core of your portfolio? Let me know in the comments down below. Now, if you're interested in this platform, this is the Koyfin platform. There's an affiliate link in the description down below. If you do click on that, you'll get a fabulous discount, and I will also get a small commission. I do enjoy the platform. I use this on a daily basis, and I think it has a lot of advantages over other platforms as well.